Here are 8 investment strategies explained. Value investing. Many people think value investing is simply buying cheap stocks and waiting for them to go up. That's the myth. The reality is that value investors are looking for companies they believe are worth more than their current market price. Imagine finding a house selling far below what similar houses in the neighborhood are worth. That's the basic idea. Here's how it works. Investors study a company's business, profits, debt, and future potential to estimate its real value. If the stock trades below that estimate, they buy it and wait for the market to catch up. The impact can be powerful because even a solid company can sometimes be overlooked or temporarily unpopular. However, patience is often required. Some stocks stay undervalued for years. In the end, value investing is less about finding bargains and more about recognizing value before everyone else does. Growth investing. This strategy attracts investors because it focuses on companies that are expanding faster than average. Think of businesses opening new markets, launching new products, and growing revenue year after year. It sounds like a strong strategy because fast-growing companies can produce impressive returns. But here's the interesting part. Rapid growth can create a hidden weakness. Expectations become extremely high. Investors may pay premium prices for those stocks, assuming the growth will continue forever. The surprising thing is that even a successful company can see its stock price fall if growth slows slightly. Once this weakness is revealed, prices can swing dramatically. The impact is often higher rewards but also greater volatility. Growth investing can be exciting, but it usually comes with a bumpier ride than many people expect. Dividend investing. Some investors want their portfolio to generate cash without constantly selling investments. That's where dividend investing comes in. The solution is buying shares of companies that regularly distribute part of their profits to shareholders. It's a bit like owning a rental property that sends you a check every month, except the income comes from dividends. Here's how to use it. Investors often build a collection of established companies from different industries to create a stream of payments throughout the year. The result can be steady income and less dependence on stock price movements. However, there's a limit. High dividends do not guarantee strong performance, and some companies reduce or eliminate dividends during difficult times. Dividend investing can provide income, but investors still need to pay attention to the quality of the business behind those payments. Index investing. For decades, many investors face the same problem. Choosing individual stocks required time, research, and sometimes a bit of luck. Then a new strategy became popular. Instead of picking winners, investors could buy an index fund that tracks a large group of companies. It's similar to buying the entire fruit basket instead of trying to guess which single apple will be the best. However, this creates an interesting conflict. Investors give up the chance of dramatically outperforming the market because they simply follow it. The advantages are easy to see: broad diversification, lower costs, and less effort. The downside? When the overall market falls, index investors usually fall with it. Index investing may not be flashy, but its simplicity is exactly why it has become one of the most popular strategies in the world. Income investing. Many people worry about generating money after retirement or during periods when they want less dependence on a paycheck. That's the financial problem income investing tries to solve. The investment solution is building a portfolio focused on producing regular cash flow. This can include dividend stocks, bonds, real estate investments, and other income-producing assets. Here's how it works. Instead of focusing mainly on growing wealth, investors prioritize investments that regularly pay them. Imagine planting a tree not for its future size, but for the fruit it produces every season. The advantages include predictable income and potentially lower stress during market fluctuations. The disadvantages? Income-focused investments may grow more slowly than aggressive growth investments. Income investing can provide financial stability, but sometimes stability comes at the cost of maximum growth. Momentum investing. Few things attract attention like fast gains. Momentum investing takes advantage of that by buying assets that are already moving upward and selling those moving downward. The logic is simple. If something is already gaining speed, it may continue moving in the same direction for a while. But here's where things get interesting. The side effect is that investors can become heavily dependent on market trends. When trends suddenly reverse, a new problem appears. Assets that were rising quickly can fall just as fast. Think of a speeding train that unexpectedly changes tracks. The impact can be significant because momentum investors often experience larger swings in both directions. Momentum investing can deliver impressive results during strong trends, but timing becomes incredibly important. Dollar cost averaging. One of the most common financial problems is deciding when to invest. Many people hesitate because they worry about buying right before the market drops. This strategy helps by removing much of that decision-making pressure. Instead of investing a large amount all at once, investors contribute a fixed amount on a regular schedule, every month, every paycheck, or every quarter. The change is surprisingly simple. Sometimes the money buys shares at high prices and sometimes at lower prices. Over time, the average cost becomes smoother. The impact is often reduced emotional stress and a more consistent investing habit. Dollar cost averaging does not guarantee profits, but it helps many investors stay disciplined when emotions would otherwise get in the way. Buy and hold investing. This strategy is often supposed to be about doing almost nothing after buying investments, but over time, it becomes something much more challenging. It becomes a test of patience. Why? Because markets rarely move in a straight line. Prices rise, fall, recover, and occasionally plunge. Investors following this strategy resist the urge to react to every headline or market scare. Imagine planting a tree and refusing to dig it up every week to check the roots. The effect can be powerful because long-term growth has historically rewarded investors who stay invested through market cycles. However, it requires emotional discipline during difficult periods. Buy and hold investing may look simple on paper, but its greatest challenge is often convincing yourself not to interfere with it.